Commercial real estate investors value their deals based on the returns those properties can generate, essentially back solving to a purchase price that will produce their targeted returns based on the projected cash flows of the investment. And with that, most investors are usually focused most on either the IRR, equity multiple, or the cash on cash return, or a mixture of all three of these metrics, each of which tell an important story about the deal being analyzed and the timing and amounts of the property's cash flow projected to be distributed to investors over time. And since these three metrics can each tell a completely different story about a deal, the logical next question becomes, which metric should I be focusing on and which metric is most important to me? And as with most questions in commercial real estate, there really is no one-size-fits-all answer here. But in this video, we'll try to tackle this question by breaking down some of the most common scenarios where focusing on each of these return metrics makes the most sense and which metric is right for you to focus your attention on as you head into your next deal. So to come up with a valuation when acquiring a commercial real estate deal, most investors will start with the end in mind, using the returns they want to hit on their invested equity in the project to determine the price they're willing to pay for the deal. But with that said, investors can differ a lot around which of these return metrics they care about most, and while no answer is exclusively right or wrong here, there are some core reasons to choose to focus on one metric over another, and in this video, we'll break down 3 questions to ask yourself when deciding on a metric to prioritize for your own deals, and the methods you can use to value commercial real estate properties based on your own unique situation and goals. So the first question to ask yourself when deciding on a return metric to target is, how am I or the sponsor running the deal being compensated? For real estate private equity firms and syndicators, one of the most significant revenue drivers for their companies is promoted interest, or the incremental profit split over and above the company's percentage ownership in the deal, assuming investors hit a targeted rate of return on that investment. The vast majority of compensation for these firms is dependent on this promoted interest, and this additional cash flow split is triggered only by exceeding a specific preferred return target on the project. For many investors, especially major institutional groups and pension funds, these organizations have promised their investors or pension holders a specific return on their money or a specific income over a set period of time, and their success or failure lies in their ability to meet or exceed those promises. And with that, a time-constrained IRR value considering all cash flows on the deal is generally the first priority for these groups, since this metric measures not only cash flows from operations, but also sale proceeds at the time the deal is exited. For smaller private equity firms and real estate entrepreneurs with just a handful of investors, while the IRR is also a common hurdle used, you'll also sometimes start to see cash on cash or equity multiple based preferred returns come into play, where sponsors on these deals want to keep things simple for investors by either referring to a pure multiple of invested capital or referring to a pure cash flow dividend yield distributed on an annual basis. For example, many individual investors without a finance background feel most comfortable knowing the exact amount of money they can expect to receive by the time the property is sold. And with that, these investors would rather hear that if they invested $100,000 in a deal, they'll get $200,000 back in total over the next 5 years, versus hearing they'll earn an annualized time-weighted return of 15% over the hold period. On the other hand, some investors might be looking to invest in real estate to provide regular, predictable income to supplement their W-2 wages or to fund their retirement, and these people will often feel most comfortable knowing that for every $100,000 they invest in the property, they can expect to receive about $8,000 per year in cash flow on the deal. Regardless of the exact structure here, when making valuation decisions on commercial real estate properties, ask yourself how the sponsor on the deal is being compensated, and this will tell you loud and clear what investors in the property care about most and how you should structure your valuation accordingly. Now, next up, aside from understanding compensation structures on the deal, the next question when deciding on a return target to focus on is, when do I or my investors need the money from this deal? For the investor that's looking to fund their retirement or supplement their income with cash flow from a real estate deal, the cash on cash return is extremely important and very well may be the metric you want to prioritize most. In addition to this, investors focus primarily on cash flow generally want to be able to rely on the income generated by the asset long term while minimizing transaction costs in the process, meaning they're not interested in the sale of the property anytime soon, and return targets that require a projected sale value to be meaningful, or really the IRR specifically, will usually be the least applicable in these types of situations. However, on the other side of the equation, for an ultra high net worth investor that's looking to find a place to just park their money for long term wealth preservation and growth, a deal producing a significant amount of cash flow each year can actually be a turnoff to this investor base and may actually do more harm than good in some cases. High cash on cash return values generally indicate high cap rates, which often only exist on deals where lower than average income and value appreciation is expected in the future. And with that, if an investor is looking to park their money in an asset long term and they won't need that money for another 15 to 20 years or more, a deal with a high cash on cash yield is likely to produce lower income and value growth over that same time period, which defeats the purpose of this person investing in real estate in the first place. Additionally, some high net worth investors with equally high incomes may actually want to avoid generating ordinary income from a real estate deal, which can sometimes increase that investor's taxable income for the year. In the case that the interest expense is low on the deal due to low leverage levels, or in the case that annual depreciation expense is low on the deal due to a high allocation of the property value to the land, there could potentially be a significant amount of taxable income generated by the property each year. And for high income earners in high income tax states, where additional income could be taxed at 55% or more in some cases, many investors would rather save that tax burden for a time in the future and pay capital gains tax rates rather than paying half of their income or more to the government during these high income years. For these types of investors, an equity multiple or IRR based target will usually make the most sense, with those in the wealth preservation category likely looking at the equity multiple for a whole dollar amount that they can expect to leave to their heirs in the future or count on for retirement over a 10 to 15 year hold. And finally, once you've asked yourself about the compensation structure on the deal and the preferred timing of the cash flows, the last question to ask yourself to choose a target return metric is, how much do I believe in the upside of this deal? Of all three of the return metrics we've covered in this video, the IRR is generally going to be the most sensitive to the sale price of the property by a pretty wide margin. And this is especially true for very short-term hold periods where a 10 to 15% fluctuation in sale value can result in massive swings in the IRR of the project. And what this means is that if you whiff on what you believe the property will sell for just 2 to 5 years down the road, investor returns can end up being dramatically different than what was projected in the pro forma, which is not an ideal scenario for anyone involved. And with that, if you feel unsure about the long-term value potential of the deal, as is the case for many investors looking for deals with higher going-in cap rate in traditionally lower growth markets, the cash on cash can be a much more helpful metric to solve for than the other two metrics on this list, since this won't require any sort of sale value assumption to achieve the return targets you set out to hit. Additionally, if you do believe in the upside of the deal, but you also believe that the upside of the project could take 10 years or more to materialize, the IRR also might not be the right fit here, since the IRR can tend to drop as the hold period is extended. Because of this, the equity multiple will often be the best fit for scenarios like this, since this metric will capture the cash flows both during the hold period and at sale, and it also won't penalize an investor for a late distribution of sale proceeds due to a long-term hold horizon. Ultimately, the return metrics that should be used to value a commercial real estate deal come down to the specifics around how the sponsor is being compensated, how quickly investors in the property expect a return on their invested capital, and how much you believe in the upside of the deal and the level of risk you're taking on at sale. And if you want to learn more about how to analyze and value commercial real estate deals, whether you're looking to break into the industry at a top real estate private equity or brokerage firm, or you're looking to do your own deals in the future, make sure to check out our premium training platform, Break Into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis, access to our entire library of pre-built acquisition, development, and waterfall models for multifamily, industrial, office, and retail deals, and you'll also have direct access to private one-on-one email-based career coaching to help you navigate your next steps in the industry or break into the commercial real estate business for the first time. And if you like this video and want to see more videos like this on deal analysis and valuation, make sure to hit the like button to let me know, and let me know in the comments which of these 3 metrics you focus on most when valuing your own acquisition and development opportunities. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.